Hello friends, today we are diving into the heart of government financial operations. We will be discussing the General Financial Rules 2017, especially focusing on Chapter 2, the General System of Financial Management. Our goal today is to understand Rules 7 through 20, which dictate how the government handles every rupee that comes into its possession. Before we look at the specific rules, let us look at the big picture. Government accounting isn't just about keeping books. It is about public trust. We will explore how money is assessed, how it is collected, and how we ensure it reaches the right treasury. By the end of this section, you should understand the chain of command from the ground level officer who issues a receipt to the financial ministry that monitors the overall budget. Rule 7. The core principle of receipts. Rule 7 is the foundation. It states a very simple but strict principle. If you receive money on behalf of the government, whether it is a tax, a fee, or a deposit, it must be brought into government account without delay. You cannot keep it in a desk drawer or a personal account for a few days. This is a constitutional requirement under Article 152(2)(83). Rule 8.1. The public account. Not all money the government handles is revenue in the sense of taxes. Rule 8 based on Article 284 deals with money received by officers in their official capacity like security deposits or judicial fines. These funds go into what we call public account. This includes money received by the Supreme Court or Union Territory courts. It's money held by the government in a trustee capacity. Rule 8.2. How is it recorded? You cannot just label money however you like. Rule 8, Sub-Rule 2 tells us every credit and withdrawal must follow the government account rules of 1990 and the receipts and payments rules of 1983. This ensures that an auditor in Delhi can understand a transaction made in a small town in a union territory because everyone is using the same language or heads of account. Rule 9. Duty of the department. Rule 9 places a heavy responsibility on each department. It is not enough to just wait for money to come in. The department must assess, meaning calculate what is owed. Collect, meaning actively gathering it. And credit, meaning ensure it is deposited. Efficiency and promptness is the key words here. Rule 10. The controlling officer's role. How do we prevent fraud and errors? Rule 10 introduces a system of checks and balances. Subordinate officers must send monthly returns to their controlling officer. The controlling officer then takes these returns and compares them against the statements provided by the accounts officer. If the figures do not match, we know immediately that something is wrong. Rule 11. Detailed procedures and receipts. Rule 11 is about the paper trail. Sub-Rule 1 says Every department creates its own specific regulations for handling revenue. Sub-rule 2 is very practical. It deals with Form GAR 6, which is the standard receipt. Departments must strictly track receipt books, knowing exactly who has which book and ensuring that used books are checked for accuracy when returned. Rule 12 and 13. Recovery and realization. Rule 12 and 13 are about financial realism. Rule 12 says you cannot just let debts sit there forever. You must either collect them or, if they are truly irrecoverable, get official permission to write them off. Rule 13 is a golden rule. Credit must follow and not precede actual realization. You cannot record money as revenue just because you expect it. You must actually have it in hand. Rule 14. Keeping Financial Ministry informed. Government departments does not work in a silos. Rule 14 requires administrators and heads of departments to keep the finance ministry in the loop. If your collections are much lower or much higher than what was predicted in the budget estimates, you must report that variation. This helps the government manage its cash flow at the national level. Rule 15. Rents of buildings and lands. Rule 15 is specific to property. If your department manages a building and it is not handled by the CPWD, you are the landlord. The head of the department is personally responsible for recovering the rent. We follow the same standards as CPWD to ensure consistency across the government. Rule 16. Fines. Fines are a unique type of receipt. Rule 16 mandates that the authority imposing fine must ensure it is deposited. More importantly, Sub-Rule 2 warns against double refunds. You must have a system to ensure a fine isn't refunded twice or refunded to someone who never paid it in the first place. Rule 17. Miscellaneous demands. Rule 17 covers the odds or ends. Accounts officers must watch for miscellaneous payments, like contributions from state governments or contractors. These aren't standard tax revenues, but they are still public money and require the same level of vigilance. Rule 18 and 19. Giving up revenue. Remission. Sometimes the government decides not to collect money. This is called a remission. Rule 18 says you cannot do this without the sanction of a competent authority. Rule 19 requires an annual report on June 1st. We don't need a list of every tiny amount under 1000 rupees, but we must report the larger amounts that we choose to abandon. Rule 19 and 20. Reporting format. When reporting these remissions, Rule 19 says we must categorize them. Why was the money given up? Was it due to a legal change, or was the debtor unable to pay? Rule 20 gives departments the power to define these categories so that the reports are meaningful and transparent for auditors. To summarize, the system we have discussed today relies on three things: speed in depositing money, accuracy in accounting, and accountability through constant reporting. Whether you are issuing a receipt or monitoring a multi-core budget, these rules are your guide to ensuring financial integrity. Okay, thank you.